Hello everyone, I'm Shobha Rani R. Today I'm going to take up the topic Accounting for Joint Venture. The modern business environment has created many other sub-forms of entities. Joint venture is one among them, though it is similar to the form of partnership, but it works on short-term objectives. These are the units established to meet short-term need and close down once the objectives are met. Generally, joint venture is initiated to support the large-scale projects and programs. Joint venture is a temporary form of business where two or more persons join together to meet the short-term objectives. The two or more people who start joint venture to achieve the short-term objectives and ready to share the risk and return in the venture are called co-venturers. The co-venturers may be fund providers or experts in their own field of work. For example, stockbrokers in case of underwriting of shares, civil engineers in case of building constructions, etc. The following are the important features of joint venture. Joint venture is a temporary business arrangement. It is quite similar to the form of partnership. Two or more people join together to meet the short-term objectives. It does not have any name or registration separately under any law. The people who are starting the joint venture and sharing the risk return are called co-venturers. The profit or loss of joint venture is ascertained at the time of closing the business. Co-venturers have unlimited liability if there is a huge loss in the venture. All the assets are received in cash and liabilities are paid in cash. The following are the differences between joint venture and partnership. Joint venture does not have any name of running business. Partnership firm has its own name of running business. Members in joint venture are co-venturers. Members in partnership firm are partners. Temporary or short-term objectives are set in joint venture, whereas long-term objectives are set in partnership firm. No registration of business under any law, whereas registration is optional but available in case of partnership form. No separate set of books are maintained in the books of joint venture, whereas the separate set of books are maintained in the books of partnership form. Co-venturers have freedom to do similar business and compete, whereas partners do not have freedom to do similar business and compete. Joint venture is dissolved as soon as its works has been completed. Partnership firm is dissolved only at the mutual opinion of partners. The following are the important differences between joint venture and consignment. The parties of joint venture are co-venturers. The parties of consignment are consignor and consignee. The relationship of parties in joint venture are called partners. The relationship parties in the consignment are principal and agent. Co-venturers have full power to purchase and sale of asset, collection of dues, etc. Consignee has to act like an agent to consignor and has limited power. Partnership Act is applicable to joint venture. Law of agency is applicable in case of consignment. Co-venturers have a right to share profit or loss of venture. Consignor and consignee do not share the profit or loss of consignment. There is a wide scope for joint venture business. It includes different ventures. The scope of consignment is narrow. It is concerned with the sale of mobile goods. More than two persons are possible in joint venture, one consignor, but more than two consignees in consignment. The accounting treatment for joint venture has been studied under two broad classifications. They are when separate set of books are maintained for joint venture, when no separate set of books are maintained for joint venture. When separate set of books are maintained for joint venture, broadly classified into two, journal entries and ledger accounts. Joint venture account, co-venturers account and joint bank account are prepared when separate set of books are maintained for joint venture. When no separate set of books are maintained for joint venture, then broadly classified into two, when each co-venturer maintain a joint venture accounts along with the other co-venturers account, then journal entries and ledger account has to be prepared. Joint venture account, co-venturers account has to be prepared. When both the co-venturers maintain the books and memorandum of joint venture account, then journal entries as well as ledger accounts has to be prepared, like memorandum joint venture account and co-venturers account has to be prepared. The co-venturers maintain separate set of books of accounts apart from their regular business books of accounts. It helps to find out the correct profit or loss of joint venture and contribution made by each co-venturer. It also specifies the balance to be paid or received from co-venturer. The following are the journal entries to be passed when separate set of books are maintained for joint venture. The first one, when the cash introduced by co-venturer, then joint bank account data to co-venturer's account. When stock or goods or any asset introduced by co-venturer, then joint ventures account data to co-venturer's account. Third one, when expenses are paid by co-venturer, then joint ventures account data to co-venturer's account. When expenses are paid through joint bank, then joint ventures account data to joint bank account. When sales are any incomes received, then joint bank account data to joint ventures account. When sale or any income received by co-venturers, then co-venturers account data to joint ventures account. When there is a profit in joint venture, then joint ventures account data to co-venturers account. When there is a loss in joint venture, then co-venturers account data to joint ventures account. When there is a debit side balance of co-ventures account, then co-venturers account data to joint bank account. When there is a credit side balance of co-venturers account, then joint bank account data to co-venturers account. The following are the important ledger accounts prepared when separate set of books are maintained for joint venture are joint ventures account, co-venturers account and joint bank account. Joint venture account, it is a nominal ledger account in corporate transactions made exclusively in joint venture to find out its profit or loss. It is maintained from the starting date of joint venture to the date of dissolution. The expenses and purchases made for joint venture is debited. The incomes and sales are made in joint venture will be credited. Finally, the profit or loss shall be found and shared among the co-venturer. Co-venturers account, it is similar to partners capital account in partnership form. It is prepared for all the number of co-venturers to account their contribution and items taken over from venture. Finally, it helps to find out how much amount will be due from each co-venturers or how much amount due to them. Joint bank account, it is similar to normal bank account. It records all expenses in the credit side and all the incomes in the debit side. The contribution of cash made by co-venturers, income through sale of goods, etc. are debited and expenses of joint venture, purchase of goods are credited. The difference balance will be adjusted to co-venturers account. Thank you.